Good evening, good morning, good afternoon, ladies and gentlemen. Thank you very much for joining me today. Could I just get in the chat box just a quick yes or no if you're hearing me, just to make sure that the audio and the sound is coming through before we get going. All righty, looks like we're doing just fine. That's great. Thank you very much. Great, fantastic. Okay, so I'm going to assume then that the sound is working. If that changes, please do let me know. But it sounds like we are good to get going. So I don't like to hang around too often or too long with these things. I like to really get into it. That's what we're here for, after all. So maybe by sort of very, very brief introduction, I think we could consider this webinar as a bit of a part two. I did a webinar with investing.com, I guess, about a month ago, and we looked at what a real edge in trading would look like. And one of the topics that we very briefly sort of jumped over was this idea that trading can be simple and still profitable. And we didn't have time to go into it then, but that's really what this is about. And I think even today, we're only going to cover a very small portion, I think, of what could be said. Okay, we're going to look at a few ideas. We're going to kind of explore this idea. So yeah, I'm very glad to have you here. It really is a privilege for me. I do thoroughly enjoy these. These are some really, really great interactive audiences. I had a lot of fun at the last webinar. I genuinely did. So yeah, let's get to it. Just for anyone who doesn't know who I am a regulated money manager. I am based in Johannesburg, South Africa. So I trade on behalf of other people. I invest my own money. I invest other clients' money. And my goal is probably very similar to yours. My goal is to make a profit in the Forex market. So I do write a little bit. I do a bit of analysis and things like that. We'll get into that, a little bit more of that as we go. So I think that's probably good enough by way of introduction. I think you've got my details, and I'll have my email address up at the end. And certainly there is a bit of a question there that you may want answered at this stage. All right, so let's move along swiftly. Let's get going. So today we're going to cover 6 topics, and we're going to have a bit of fun doing it, I hope. They are this idea of a complexity bias, all right? And then I'm going to make fun of technical traders, of which I am one. Okay, so I'm putting myself up front right at the beginning of all the groups I'm going to make fun of. I'm going to make fun of myself first. I'm going to make fun of fundamental traders, putting the fun back into fundamentals. And then I'm going to make fun of Elliott Wave traders for no particular reason. I just picked the Elliott Wave trading system to sort of pick on, I guess, if you will. And then we're going to look at the big and simple mistake that most traders make. And then finally, we're going to wrap it up with a very simple system that I'm going to show you, kind of putting this all together and taking a very simple approach to the markets, if you will, and how it actually produced a very effective and impressive result. So quite a bit we're going to get through, but I think maybe just a bit of housekeeping as we get started. If you have any questions while I am going, please do pop them straight into the question box. I will attempt to answer them as we go. If it's something that I know that I'm going to cover a little bit further along, then I may ignore you. Of course, sometimes I get a whole bunch of questions that come through very, very quickly, and I may miss your question. So I will go back and I will try and cover it again. If I do miss your question completely, please don't think I'm ignoring you. It could literally just be that I'm missing it. They tend to come through a bit quickly, but you'll have my email address at the end. Send it through, right? As I said in the last webinar, I'm more than happy to engage with everyone here who would like to chat further about any of these topics. Please send it through. So maybe just as an overview, tonight or today, wherever you are, we're going to be discussing the simplicity and complexity in the market, and it's more of an idea. Okay, the idea here is that I want to put into your mind that sometimes you need to challenge some assumptions or beliefs that you may have that we all tend to pick up on the way. So, you may come out of this with a few more questions than when you came into it, and that's okay. All right. The idea is to challenge the beliefs, challenge the information that we get fed every day. And we'll basically go from there. And of course, the end result is that we all become better traders, right? That's essentially where we want to go from there. So I'm happy with that. If there are any questions, I'm sure there probably isn't too much at this stage. Thanks for all the messages that are coming through. They're really appreciated from everyone here. So let's start moving on. So the first point that I wanted to to cover is this idea of a complexity bias. So I've got a very nice definition up there. It's not mine, but it's a really nice sort of cover of what this is all about. So it's the belief that complex solutions are better than simple ones. And then I think the second part of it is even more useful. It says the term denotes an irrational preference for complexity over simple approaches that are faster, cheaper, and safer. Now, sometimes it's quite difficult to pick up where this might be happening in our lives. And I had a sort of a thought about this practically. And, if you've ever worked for a boss who kind of likes the complex approach, so, you get given some sort of problem to solve by your boss and you come up with a solution that's going to take you, 2 hours to implement and, a fairly straightforward, simple solution. And your boss looks at it and thinks you're being lazy, right? Because he or she is sitting with this complexity bias. They've got this kind of in the back of their minds, they've got this idea that it has to be complicated to be effective. So if you've ever experienced that, you kind of know what I'm talking about. If you've never experienced that, I envy you greatly, I must admit. But that for me is just perhaps one sort of example of this complexity. But we're going to look at a few more. And then I guess that's the overall topic of this webinar anyway. So we're going to be basically unpacking it for the sort of the whole evening. We're going to have a bit of fun to get started. So this complexity bias into the idea of a song, and I've already shared this idea with a few of my members, but I thought I'd share it in the bigger sort of arena here. It's quite a lot of fun. So if we take a modern approach to building something or producing something, so in this case a song, and we add a whole lot more inputs to it, are we going to get a better product or a better output? So that's the complexity bias, right? It's about saying, the more we put in, we're going to get a better product. And I found quite an interesting example. I'm sure many of you have seen this before, but if you haven't, it's quite funny, so it's worth a look. So we've got one song. I think it was a chart topper. I have no idea, but it had 4 producers. And it had 6 writers, and we're going to compare it to another song that was quite a bit older, that was written by one person and produced by one other. And I'm sure, as I said, I'm sure many people have seen this before, but here it is, right? Yeah, the two of them are together. It cracks me up when I see this. I think it's hilarious. I apologize to any Beyonce fans out there. I did find the worst picture I could on the internet. Not too difficult to do, believe it or not. If you're curious, Freddie Mercury looks great wherever you're online. But this is kind of the idea, right? So we've got Bohemian Rhapsody on one side. I think it's won countless awards. It's still regarded as, I think, the best or the most amazing song, or whatever you want to call it. It's in every single award, anything you want to find. And there it is. And we sort of compare it to Beyonce's song. So we've got this idea here, and obviously this is just a bit of a sort of a comical look at it. But we've got this idea where we've got one song that's got all these inputs, it's got all this all these sort of things going on, and the product just doesn't compare, right? And I thought it was a nice analogy, obviously a bit of a fun analogy, not to be taken too seriously. Again, apologies if there are any Beyonce fans out there, but I just thought it was a nice sort of example. So let's take this idea and let's start looking at how this may translate into trading, okay? Because that's why we're here. And what I'm first going to have a look at is sometimes how we see this idea that a more complex approach is better, okay? Sometimes you're going to come across charts that look like this. Now, again, I don't think this is too serious. I think it was someone taking the mickey. Although, to be honest with you, as with any good joke, I've seen charts that look pretty similar to this. But this is not all too uncommon, is it? All right, you get these charts that are full of indicators, full of trend lines. I don't even know where the price is in this chart. So maybe this one's a little bit extreme, and possibly it is just a joke. This one isn't. Okay, so this is a chart that I did find that someone was actually using to make trading decisions in the market. And, I wouldn't spend too much time looking at that. It'll certainly give me a migraine if I spend more than a few minutes looking at it. But it's quite something, right? And this is this complexity. This is the other way we see it. We see more indicators. We see more trend lines. We see oscillators. We see all sorts of things, right? What happens is we take a loss and we think we need to add more to our systems, and that's somehow going to make it a more profitable system. And that's where these kind of things happen. And then the last way that we typically see it, and again, this is just sort of scratching the surface, is this kind of thing, okay? I've seen lots and lots of these. Most of them, I don't have a problem with having a couple of screens. It certainly makes your life a bit easier. But I've also seen setups like this, right? Maybe you have, maybe you haven't. This is some guy's work from home space, which it apparently looks like he's trading. I'm not entirely sure, but there's quite a lot going on there, right? And we tend to see these things, and we tend to think that this gives us, or this trader has some sort of advantage over us because of all these custom indicators, or these sort of fancy screens and the setup that we don't have, or something along those lines. And obviously the topic of this webinar is that my belief is that that's not true at all. And I guess my hope is that to maybe challenge some of these assumptions. So let's move on to look at a couple of sort of trading related things. So we're going to look, this is the technical part of it, when I said I'm going to make fun of the technical traders, of which I am one of them. So let's have a look at some information that the market gives us. And I'm going to bring up a chart here. All right. Can you all see that chart? If you can, okay, can you tell me in the question box if you can see any pattern or any sort of shape or any movement there that is of any significance to you? And if you can, give it a name, please. I'll give everyone just a minute to go through that. Yeah, answers coming in. Keep them going. Keep them going. Okay, lots of different things there. All right. Yeah. Yeah. Okay, great. Thanks, everyone. Okay, so we have several different ones. The most common. Sorry, the reason why I'm laughing is that we've got probably 5 or 6 different names that have come up, and that's actually going to work quite well for this example with what I wanted to show everyone tonight. But the most common name that has come up here tonight, and what is most commonly identified here, would be the Head and Shoulders. Okay, so if you called it something else, please don't stress. It really doesn't matter. There's certainly more than one way of looking at it. You're not wrong. Okay, if you didn't call it a Head and Shoulders, don't worry about that at all. But most commonly, that's what this is called. So you can see we've got the left shoulder, we've got the right shoulder, we've got the head, we've got quite a nicely formed neckline. I obviously haven't put the pair here or the instrument or anything like that. It doesn't really matter at this stage. Okay, the point was to say, well, we kind of see these patterns in the markets, and if you're a technical trader and or some sort of technical trader, you assign some sort of meaning to them, right? So let's use that information and let's move forward. So we're going to call it the Head and Shoulders. And what I've gone and done for you here is I looked up quite an interesting piece of work. If you've never read it before, I highly recommend it. It's the Encyclopedia of Chart Patterns by Thomas Bulkowski. And what he did is he analyzed dozens and dozens of markets over many, many years. He literally took as much information as he possibly could, and he started pulling out of these markets and these patterns, and he started trying to assign or create a very scientific approach to evaluating the sort of effectiveness of these patterns, all these different patterns, right? So everything you can imagine is here, from a single candlestick pattern like an engulfing candle, or even the Japanese candlesticks, the dojis and things like that. He did everything, and he did the bigger patterns too, right? So your wedges and your channels and your windsocks and your triangles and really whatever you want to call them, right? He did them all. It must have been a mammoth task. He's got a lot of it for free online. If you just Google the pattern, I think it's the pattern site, you'll find it. But anyway, so what Thomas Bulkowski found when he analyzed all of these different chart patterns is that the Head and Shoulders pattern, the traditional Head and Shoulders pattern, which is arguably what we have here, was the number one pattern out of all of the patterns that he tested, out of the 21 patterns that he tested. That was the best out of the lot. And you can see that with the performance rank here. And that's really what I wanted to sort of show everyone, how sort of obvious these are and how popular they are, right? I mean, if you Google Head and Shoulders, you'll find 5 markets that were allegedly printing them today, and you'll find people talking about them and where price is going to go, etc., because they are generally fairly easy to identify, and they are quite reliable, right? Or at least they have been. Keep in mind, I know there's probably a lot of forex traders on here. These statistics are particularly, the ones that I've got published here are are particular to stock markets mostly. All right, so that's why you'll find different performance statistics between a bull and a bear market. Obviously, that is, it's obviously quite different in stocks to forex. Anyway, so this was Bukowski's findings, right? So we've got this head and shoulders, nicely identifiable. It's our best sort of chart pattern, let's say, for example. All right, so let's start looking at this. Can we use this information to assume that the market is going to go down now? Okay, so this is not a trick question, all right? As someone I trade with regularly says, he says you pays your money and you takes your chance, right? So you identify a setup, you work out your risk, and you pull the trigger, right? So with what we've looked at now tonight and looking at this chart, would you be happy to say that this is some sort of signal that it's going down? And if so, could you give me some indication of what level of confidence that you have in that? Now, again, this really isn't a trick question. I'm not going to, I'm not looking to try and catch everyone to say down just so that I can show you that it's a busted signal. Okay, there's no real point to me doing that. But would you feel that it's a fairly good indicator that the market is going to move down from now? I'll give everyone just a few seconds to have a look at that. Okay, a couple of messages coming through here. Thank you. Yeah, I have to agree with Domingos. He's got a high confidence below the neckline, but could retest, yes. So if I was looking to trade that, I'd wait for a break of the neckline. And I'd look for some sort of short. But okay, cool, bit of more confirmation, no problem, right? But generally, when traders identify the head and shoulders, they're looking for a reason to sell. Okay, now what I wanted to do is we're going to play this game, do this exercise one more time. Okay, and we've got a slightly different setup here. Okay, so let's just sort of hold those thoughts in our minds for a minute, and let's have a look at a slightly different setup. So this one probably doesn't have as much information if you're a technical trader. Perhaps there's not that much that you can use here, but if I was to give you some sort of basic analysis of my opinion, of course, that doesn't necessarily make it right, but I would look at this as a market that sort of was consolidating for a while. It broke out higher, and the last sort of 3 candles are actually pretty bullish, I would say, in my opinion. And then the last candle is a small sort of inside. I think it's an inside candle. Harami, right? So that's been posted. These obviously do have names. So does anyone see a discernible pattern here? Is anything quite so obvious as what we saw in the previous chart? Anything really stick out there? Anything have a lot of meaning to you? So yeah, what does the last, or the black bearish candle, the last candle in the row, tell you? Does that give you any feelings for where this market is going to go? Yeah, kept close. All right, Haramis. Yeah, okay. So we've got a couple of conflicting opinions here. I like that, because the interesting thing, of course, is that if you're a trend trader, you're looking at it as an inside candle, and you're going to expect a breakout for the trend to continue. If you're a reversal trader, you're looking at it as some sort of harami, but this is a lot more mixed. Okay, a lot more mixed response. And what I wanted to sort of have a look at here this evening is this idea that we tend to do in technical trading. So this is exactly the same chart. I think a couple of people picked up on that earlier. If you've never considered this before, I think that it's certainly one of the most valuable. It's one of the most obvious, but it's also one of the most valuable things to realize in your trading. Okay, so what I've got here is that simple little black candle that kind of gave everyone I wouldn't say confused everyone, but we had a very mixed bag as to whether it was going to go long or whether it was going to go short. That was a weekly candle, and the 4-hour chart that I showed of the head and shoulders, okay, was the 4-hour candle that made up that week. Okay, so the interesting thing, of course, that I find of this, and we'll sort of catch on with that a little bit later. We'll follow up with this here, but what we tend to do is we tend to attach a story to the Head and Shoulders, right? We do that to make sense of a complex market. And obviously, you know, if someone's doing analysis, they're writing about pairs, they work for a bank, they work for a fund, they do whatever they do, they trade for themselves. It's nice to have a Head and Shoulders that you can write about, and you can tell a story to yourself, and you can pitch, you know, even to give yourself the confidence that you need to take a trade. But in actual fact, they're no different. Okay, but you'll find this need that we have to tell ourselves stories coming up all the time. Okay, all the time. And it comes down, in my mind, it comes down to two things. The first is that we feel good because we think we can predict the market. Okay, we think that you know, that gives us some sort of advantage, and it also helps us to make sense of what's going on. Okay, we look at some sort of pattern, we think, yes, this makes sense. This is how I'm going to take my trade. So I wanted to just share that with everyone. Okay, and then the last question there. So, is the Head and Shoulders still so much more significant than the simple bearish candle? Okay. So have a think about that. All right, have a think about that, because both of them represented the price action of a week. One of them had everyone, or most people, happy to load up on the short. The other one, not quite so convincing, right? Everyone was sort of looking at it, thinking we need to go long, we need to go short. Who knows, right? So whether the sort of full market is participating or not, what's the difference? Okay, we can sort of argue about a lot of things. We can say, well, you know, the market's in an uptrend. Someone will say the market's in a downtrend. Someone will say it's going nowhere. But there are only a few things that we can really 100% know for sure. We can know the open, we can know the close, we can know the high, and we can know the low. The rest of it has a story attached to it. Okay, and I'd just like to point that out to everyone. So sometimes I think it's especially as technical traders, we tend to create a narrative, we tend to create a story that supports what we want and is not always necessarily there. And we also tend to add extra weight to patterns that simply show up on lower time frames. And the other mistake that we make is we add weight to patterns that are rare. Okay, there's another bias that we have. When a pattern shows up that we don't see too often, we automatically assume that it is more important than patterns we see all the time. Have a think about that, all right? There's absolutely no evidence to support that whatsoever. It's rare, so we think it's important, but it isn't. All right. Let's move on from the sort of technical side of things. Okay, I'm not going to focus too much on that. I just wanted to point that out. I know it's especially for newbie traders, it's not something that people tend to notice early on in their trading, and it can make a huge difference to your trading. So let's now have a look at the more sort of fundamental things. Let's have a look at the story versus the fact here. Okay, and just while we go through these, keep in mind what we're trying to do is strip out the complexity here. Right? We've got one thing that has a lot of meaning, and we've got one little candle that has a lot less meaning, and we're willing to assign a lot more value to the one than the other, but really they're kind of the same thing. So keep that in mind as we go through this idea of story versus fact. So let's keep moving. I wanted to show you something else. So I took this off investing.com. I think I put this together on Tuesday last week, perhaps Monday or Tuesday last week. And I didn't look too hard, right? I literally I picked up 3 headlines. I wasn't particularly fussy at all. But something that I wanted to point out, and something that you're going to see again and again, is this idea that, there's a story, and then there's a fact around it. Okay, and the two of them, one of them is sort of not debatable, and the other one is really whatever we want it to be. So if you just have a look at them, the first one is Wall Street opens lower. Fact. Okay, it closed at one price one day, and it opened the next day at a different price. Okay, the second one is the same kind of thing. It was Wall Street is lower, basically, as North Korea tensions wane. Now that's a story. Okay, Wall Street is lower. Fact. Okay, it's trading lower. North Korea tensions is a story. Okay, let's even have a look at the last one. We've got oil prices push higher as U.S. refining activity resumes. So oil prices push higher, fact. Okay, we can see they're higher. U.S. refining activity resumes. We don't know if that's the case. And the reason why, I sort of wanted to bring this up is you often, or traders often have this misconception that the pros sitting behind their desks are assimilating and processing a lot of information. In fact, that they need to. And the reality is it's not true at all. Most traders, in fact, all good professional traders that I know, have very simple systems that they follow in the market. And if there is a piece of information that has nothing to do with their system and has no interest in, that doesn't interest them at all, they simply file it away and ignore it. All right. Traders are not processing huge amounts of information. If I'm trading oil and I see the oil price going up, I don't care what made it go up. All right, so I'm not particularly interested. And we'll talk about this news idea a little bit sort of further here too, because a lot of the time it just gets blown out of the water. So let's have a look here. So ask yourself this question. We're talking about the North Korea moves, let's call it that. So if North Korea wasn't doing anything, okay, if nothing was happening there were no bombs or missiles or rockets, and Wall Street was still down, what then? Okay, what then? And the simple answer is, I'll tell you what the simple answer is. All that would happen is we would assign another reason for it. Okay, price can't just be up or can't just be down. No, we as traders need to assign a reason to it, and we have no evidence whatsoever that that reason has anything to do with price. Okay, so I just wanted to sort of point this out. Have a look at the narratives that you are seeing. All right, let's have a look at another example here. So I took this one, I think it was Monday or Tuesday last week. I'm not entirely sure, and it was basically the dollar falling on concerns about North Korea and the Fed outlook. So I guess it was before the FOMC sort of news that came out. I guess that's when I took this. So I brought up a chart. Okay, and I kind of highlighted the whole day's range there, and if you put on your microscope, you can see the open and where the sort of current close or where the price was trading then. So I think price was about 20 pips up at that time. It had a bit of a spike during the day, but really a pretty insignificant, useless day, if I'm honest with you. There's nothing fantastic going on there. So on this day, we've got the dollar falls sort of on concerns about North Korea and the Fed rate outlook. Okay, well, maybe the dollar's just falling, because if you have a look at this chart, we've had fairly consistent buying from about December last year. So we've had 8-9 months, sure there's been some dips, but we've had 8-9 months where the dollar has been falling. But on this day, we needed to write a story about it, or someone needed to write a story about it, and it happened to be the reason happened to be North Korea and a Fed rate outlook. And if North Korea wasn't doing anything, it would have been blamed on the Fed. And if the Fed wasn't doing anything, it would have been blamed on something else, perhaps something positive in the Euro space. Do you see how this sort of news information, all of this news information is really just a story and it's noise? Okay, there's very little value to a lot of it. Okay, it's literally just a narrative to try and help us to understand complex systems, but it doesn't necessarily add much more value. Okay, let's have a look at one today. This one I took today. I wanted to see if there was anything interesting. So this one came out, I think it was around about midday my time today. So it's also around about midday London time. And it was stocks build on record highs as Irma weakens. All right, so I switched to a weekly chart there, so you can obviously see the massive bull run that I was just using one of the S&P products here, but you could pretty much use any stock market. They were referring particularly to the US stock market, so I figured it would do. Okay, and that sort of tiny candle right at the top right, that's your news event. Okay, the fact that we've been in a massive bull run and buyers are still coming in. How do you know you're in a bull market? Well, you're in a bull market when every time you have to buy at a higher price than when you sold. Okay, last time you took profits. So guess what? Price is still going up. As much as we want it to go down, and I'm pretty, I have no bias on it particularly at all, but I know a lot of traders are sort of jonesing for it to go down, right? Everyone's saying it's gone too far. We've got this bias. It's gone too far. It needs to come back. Well, who knows? It can do whatever it wants. But the story, the narrative that we've built ourselves, that it's on record highs as Irma weakens. I mean, really, if there was no hurricane, it would be another reason. Maybe it's just higher. Okay, so I'm not going to hang on to this too much longer. I just wanted to point that out. Okay, so we've looked at two topics so far. We've looked at sort of complexity in our technical trading, where we tend to add complexity that's not necessarily there, and we tend to assign complexity to patterns that on a different time frame don't show anything. All right? But one means so much more than the other. And now we've looked at this idea of a lot of the news, okay, a lot of the narrative that we get pushed, a lot of the things that we get told. And if I can give you a piece of advice, start stripping out fact from story. It will certainly improve your trading. So let's move on to the next part of what we're going to look at today. And this is the idea that complexity is used to confuse on purpose. Yeah, I got an interesting question here. Sorry, I'm going to pause that for a second. So you're saying no need to read anything. So here's what I would challenge you to do. We're going to do a bit of a test later on. It won't take us too long, and we're going to go through the very simple trading system. And we were trading a purely participative approach. That will make sense when we get to it. We were not following any news. We were not looking at what North Korea was saying, or the USA was saying, or the Fed, or any market, and we were doing just fine. So do I think you need to read anything? No. I don't think you need to read anything at all. You need to learn a trading system, and you need to follow it through. The challenge, of course, is learning your trading system and figuring out what works for you. So a bit of a sidetrack, but no, I don't think you need to follow the daily news at all. Not in the slightest. Yeah. Okay. Complexity can be used to confuse on purpose. So let's have a look at this idea here. All right. And this is where I said I was going to pick on Elliott waves. And the reason why I wanted to sort of bring this up and the reason why I wanted to point it out is firstly, just to say that it's absolutely nothing personal. I know a couple of traders, and I must admit only a couple, who do very well with Elliott waves. Okay, they certainly have value. It's not something I trade. It's just not something I've ever gotten my head around. But like any trading system, some work for some people, doesn't work for other people. So I have no problem with the tool. I have no personal issue with it. All right. So obviously, it's just not something that I use. So I just wanted to put that disclaimer up there. If you are an Elliott wave trader, please do not be offended by this at all. All right. I already picked on the technicals and the the fundamentals. So let's see what often happens in the market, and it's really the third point here that I want to sort of talk about, is this idea that many traders tend to even fool themselves with their analysis. Okay, they're using a complicated system or a complicated approach, and whether we decide Elliott waves are that complicated or not, it doesn't really matter at this stage. But they use a complicated system and a complicated approach, and they tend to fool themselves into thinking they know what's going on. So let's have a look at some examples. Now, again, I am not an Elliott wave trader, but so we'll do a quick crash course. I'm sure there are people on this webinar. I'm sure there are people on this webinar that are much better Elliott traders, or at least use this tool all the time. Great, happy to have a chat with you after this. You can educate me. This is my understanding of the basic idea. You've basically got kind of waves, okay, and it's fractal in nature. So what that means is kind of as you zoom in on higher or lower time frames, you're going to see the same patterns repeating themselves. Kind of cool, actually, how the markets work in fractals. I've always loved that. But the idea is that the market sort of follows this pattern. Now, if I was trading this, this is the same kind, or this is the kind of thing that I would look for. Okay, I would say, well, if I've identified wave one is some sort of up wave, and let's say we're looking to trade a bull market, and then there's this pullback. Okay, there's this wave two pullback. So I had a look at an Elliott wave chart, and I believe wave three is always the biggest. So I guess that's the one that I would like to trade. Okay, for example, I think probably the safer way, if I was looking at this, would probably be to trade wave 5. So you've got two pullbacks, I guess. Maybe that's more confirmation. I don't know. I'm by no means an expert in it at all. But let's say, for example, we're going to go the first way that I said. So I identify wave 1. I see the pullback wave 2, and then bang, I'm ready for wave 3. Okay. I'm keen to go along, and what we see, and a lot of people have already pointed it out. Thanks for the comments. Yep, absolutely. It looks like Fibonacci. Exactly. It is very similar. And I think there are similar kind of fundamentals. We can talk about Fibonacci's in another webinar if you'd like. But what we tend to see happen here is they get abused. Okay, so certainly there are practitioners who use them properly, who use them in a disciplined manner, but this is the kind of thing that happens. All right, we get our impulse wave. Remember, sort of 1 was our first wave, and then 2 was the pullback wave. And then the challenge comes in is when does wave 2 end and wave 3 starts? Now, is it where it bounces the first time or the second time or the third time? Obviously, the first few times you took a loss, smack on the nose. Right, and that keeps happening again and again and again. Obviously, eventually it bounces, and everyone can sort of take a step back and say, "Wow, this really works. This is fantastic." But pity about the first two that didn't work at all. But what I really wanted to point out is if you just bought all 3 bounces without any analysis whatsoever, you'd be in exactly the same place. Okay, so price is moving down, it starts closing up, you take a buy, you'd be in exactly the same place. But what does the Elliott wave, and I think one of the reasons why it remains so popular is what does it help you to do? And primarily my belief is that it helps you to tell a story. Okay, it helps you to tell a story about what's happening. So, you believe the market is in some sort of uptrend, you believe you've seen some sort of retracement leg, and you believe that the market is going to carry on. So that helps you with some sort of narrative. Okay, and I mean, there we go, right? So now with the benefit of hindsight, it's pretty easy to draw my Elliott waves. I've got my number 1 wave goes up really nicely. Got my retrace too. There it is. Boom, picked it down to the pip almost, and there it goes up. But like I said, I don't use Elliott waves. I can only do that in hindsight, to be honest with you. But my challenge is, and I just picked on this for sort of one example, but I can do it with any indicator you like. You can do it with sort of more traditional price action, as we looked at. We have these complicated approaches to the market that don't necessarily make deriving any profits any easier. Okay, I've seen traders get lost in Fibonacci's. I've seen traders, apart from losing their accounts, but literally get lost because they start zooming in on different time frames. They start zooming out and trying to analyze and predict where the market is going. And it literally just doesn't work. Okay, it doesn't work, and they just never get anywhere. So if you're a great Fibonacci trader, if you Elliott wave trader, and you use them for profits, please do drop me an email. I would love to have a chat with you. It's not a challenge. It's not meant to. I'm not mocking anyone. I genuinely am not mocking anyone. But I do see this often as one of the ways that the market is. It's given this additional complexity that doesn't always exist. All right, and that makes it a much harder. A funny message here from Yanni. He's talking about tidal wave and moon gravitation, lunar eclipse. Yeah, so there's quite a bit of astrology actually in trading too. Believe it or not, there's literally every approach under and above the sun. So, so the question is at this stage, and we're going to get into the more sort of practical aspect of what we're doing here this evening, is does all this analysis, which adds to the complexity, automatically mean more profit? Now remember, that's the complexity bias, right? We've got this bias, it's built into us. Most of us are going to feel that way. We're going to feel that if we're taking a more complex approach, are we going to get better trades, better entries, and more profits? So let's not even answer that question just yet. In fact, we're not probably even going to answer it at all in this webinar. Like I said, the idea here was to perhaps challenge a few biases and look at a few ideas. But let's talk now about where most traders go wrong. Okay, let's move on here. Let's start looking at some simple statistics. Okay, like I said to you, we can argue about what a market's doing all day long, and there's a few things that we can't argue about, like the open, the close, the high, the low, and the current price. But everything else we can argue about. So let's stick to some figures and let's talk about where most traders go wrong. Okay. This was a really interesting piece of information. You can Google it, you can find it. It was a study done by DailyFX, and what they did, they got hold of 40 million trades. I know a couple of traders that trade so much that might just be 1 or 2 people. Just kidding. So it's a whole bunch of retail traders, literally 40 million trades. So we're not talking about sort of simulated trades or back-tested trades. We're not talking about anything apart from real trades with real hard-earned cash on the line. And what they did is they attempted to analyze these trades to try and answer this question. Okay, we've all heard it, most traders lose and whatever, 95% are not profitable, the whole kind of sad story. I'm not going to go into that again, but they decided to crunch some numbers and answer this question. And I love this piece of sort of this research. I think it's fantastic. So if you have a look at the chart that we've got down here, this is the percentage of all trades closed out at a gain versus a loss. Okay, so the blue at the bottom, apologies for those who are colorblind, I couldn't change it, but the blue at the bottom is the winning percentage, and the red at the top is the losing percentage. Now, obviously, you want to win more often than you lose. And what we find on this chart is that we are good at winning. Okay, I think every single pair here showed that over 40 million real trades, most of the trades were won. Isn't that interesting? That literally blew my mind when I first saw that. I didn't expect to see that at all. In fact, I was reading some of the research. I went into the article, and for a long period, the euro dollar, which is obviously everyone's favorite, was trading at almost a 60, or not trading, but the figure was hovering at almost a 60% win rate. And I thought that was just staggering. So we're talking about retail traders, the guys who are always getting the hard rap, that are being told that we're all pretty useless. Okay, we don't make money, we don't know what we're doing, and yet there we go. Okay, most retail traders were winning up to 60%, and you can see on every pair there we go. Okay, 40 million trades, we're winning. So where's the problem coming in? Well, this chart is what's going to tell you where the problem is. So this shows the average gain versus the average loss over the same pairs. So where we were winning sort of 55% of the time, you can see that the size of our losers, so this is a sort of relative loser versus winner size, was so much bigger than our winners. All right, so take a bit of time and just have a look at that chart, especially the euro dollar chart. That's the first real big bearish bar that sticks out there. And you can see quite clearly that in some of these pairs, our losers are almost twice as big as our winners. Okay, so I think the problem is starting to become a lot more clear here. So what we've got is we have what I have often termed entry agony. And what it is it's when we complicate our entries. Okay, and how do we complicate them? Well, these are obviously just some of the examples. We've got time frames, we've got multiple systems, we've got price action or technical analysis, we've got indicators, we've got lots of different markets to trade, we've got long-term fundamentals, things like interest rates and sort of general economic growth or decline in different areas. We've got short-term news releases, right? Everyone piles onto the non-farm payrolls. What does the number mean? Where is it going to go? How's the market going to respond? We've got professional research, which is is an oxymoron at the best of times. We've got all these opinions via social media. Twitter's ablaze. We've got all the different sort of sites with everyone commenting on it, and we've also got our recent trade history. Okay, so our own performance is very likely going to implement our next trade. If you just took a loss or a couple of losses in a row, you know how hard it is to pull that trigger. Okay, it's not easy. It gets harder with every additional loss, and that's certainly a different topic. But all of the stuff that we've been discussing so far today, and whether you agree with it or not, and I'm like I said, I'm more than happy to chat with anyone who disagrees with me, and my objective is not to convince you to my way of thinking, by no means. But if you disagree with everything that I've said, you have to agree with one thing. You have to agree that we tend to complicate our entries, and yet the statistics show that we're actually pretty good at winning. All right, we win more than half of the time. That's ideal. That's what we're supposed to do. So the problem is that we need to make our winners bigger than our losers. Okay? That's really what it is. And all this additional complexity that we add to it, why is it moving because of North Korea? What's the Fibonacci saying? What's the Elliott wave saying? What's the price action pattern? Whatever, all that kind of stuff. None of that is going to help us make our winners bigger than our losers. And this is where we fall short. All right? So we've got this idea that complexity, it can be used as a tool to keep you playing the game, right? And you never really get ahead with it. So, we tend to focus on systems, and we trade a system for a while. It doesn't work. We churn our accounts, and we'll talk about brokers booking that another day. But we churn our accounts, we move on to another system, and we carry on going. We win a few trades, and we stay on the wheel, right? And what we should be focusing on is making our winners bigger than our losers. And I think this complexity that we see, and make no mistake, the market itself is very complex, but I don't think our approach needs to be. And that's really where I'm going to wrap this up. So we've got another 15 minutes. It shouldn't take that long. I think we'll only need about another 10. But I wanted to share with you now a trading system. Okay, and before I go into the details of it, I'm not advocating that you should trade this. What I said at the beginning is that we're talking about ideas tonight. Okay, we're challenging assumptions, and maybe you can take some of this information or some of these ideas and you can challenge some of your own assumptions. But that's really what this is for. Okay, yeah, some great comments coming through. Thanks for everyone. I do appreciate it. So let's keep moving. I don't want to run out of time. So what we're going to do is, and I just picked these rules. All right. I decided I was going to trade one single market. It was the dollar yen. It was a completely arbitrary decision. I decided I was going to trade the daily time frame. The reason for that is basically so that anyone could trade it, regardless of how much time you have in front of the charts. And the whole system is basically summed up in point 3 and point 4, where it says we will buy the low of the month and we will sell the high of the month. Okay, and then point 5 says we will not use any tools to predict the market's moves, and we will simply take profit when there is profit available at the end of the month. Okay, so we're not going to hold trades into the new month. So if you think about the rules of our system, we've got this idea that the entry rules are extremely simple and mechanical. All right, there's no pain to enter. We don't have indicators that need to line up. We don't need anything. And what that means is that we're really aiming to just participate in the move. So our advantage here comes from not from picking great entries. It comes from letting our winners run. Okay, question on position size. I'll chat about that in a bit when we sort of put it all together. But very conservative. I worked on a simple 1R, which would be 1%, but we'll get into that. So that's the point here, is this idea of letting your winners run. Now, if you were to take this and sort of work on a system like this, I would highly recommend you started looking for multiples of R as a winner. So like I said, we just closed out here at the end of the month. I didn't add any more finesse to it than that. But if you look for a 3-to-1, 4-to-1, 5-to-1, even 10-to-1 trade sometimes, I'm sure your win rate's going to suffer, but we've established that's really not where our problem is. I think you'd be very surprised at the results. So the tricky part is, how are we going to buy the low and sell the high? So it's pretty straightforward. All right, I've set up a little example here. So basically the month gets going. These are all daily bars. You can see from the dotted line, the start of the month. The month gets going. All right, it starts moving down. As you can see that it spends, well, I guess about 2 weeks moving down, somewhere around there, and then it closes up and starts breaking out. And we would simply, once the price had closed up with the candle I've marked II, we'd simply have a buy order above that candle and we'd be triggered long. Okay, that's how we'll buy the low of the month. Now, the obviously question is, do we know with 100% certainty that we have bought the bottom? Of course not. Okay, at this instant in time, we believe we have. So, we do expect to get stopped out quite a bit. But our goal is at the end of the month, we will have bought the bottom and we will have sold the top. So we're going to keep going until we do exactly that. All right. And then just one last point here. To make sure we don't move or miss out on any moves out the gate, we'll trade the breakout of the first candle of the month too. And that's not changing the rules of the system. All we're doing is saying is that the high of the month or the low of the month may be established by the first candle. Okay, and we don't want to miss it. That's all we're saying there. So maybe a little bit confusing. I'm going to switch to a quick video here. Can everyone see my video? Can everyone see the video? Video screens come up. It just looks sort of a black and white chart. Yeah, okay, great, fantastic. So this is just, this is me doing a little bit of trading, and I recorded it. This is just a part of it, sorry, apologies. And I just wanted to sort of show it to you so you could see how simple it was. So I started from May 2014. All right, we've got the first candle of the month here. You can see that it closes up. I'm going to pause the video every now and then just to sort of explain what I'm doing. I'm not breaking any of the rules, but it's not always that clear as to the reasons why. So because the first candle closed up, we put a buy order and we go. All right, and you can see the next candle. So I'm using Forex Tester here. That's why I'm able to advance it so quickly. What happened, of course, is price really spiked up really high, and now it's closed down. So the implication is that we've probably seen the high of the month, so we need to be ready to sell, and we're about to take our first loser right on the nose. Alrighty, so that's me placing a sell order. We'll talk about the risk in a bit. All right, so what you can see happen there, you can see the buy order stopped out and the sell order triggered. Now, these two candles next to each other, what happened with this data set that I was using is I was dealing with Sunday candles. Okay, so these two candles together here refer to the Monday candle, just so that everyone's on the same page. That happens throughout this test. I will mention it as we go through it, but what I'm basically doing is combining these two in my mind. So all we've had here is a candle spiked up, closed down, I set the breakout, and just in the single day after that, price closed lower. So have we sold the high? Let's see how it goes. Price is closing up, need to be prepared to buy the low. Didn't happen. There it closed up again, so we're going to try and buy the low. Okay, wasn't the low of the month, we get stopped out. Our short is still carrying on. We get another attempt at the low of the month here. There we go. Okay, we must be nearing. Yeah, there we go. I think I'll go back a candle here. Yeah, and all I did there was close out the position. So we managed to eventually buy the low of the month, and we managed to sell the high of the month. And I think we took two losers, or three losers in the middle. I'm not sure. We do have the stats later on. So I'm going to move through it quite quickly now. We had the breakout from what appeared to be the low of the month. Price is reversed, so now I need to sell what I think is the high of the month. I don't know. All right, that wasn't the low of the month. And you can see there we have price closing up and breaking out. So we need to try and buy the low again. We may have secured the high. I don't know. All right, stopped out. We did not secure the low. All right, so in this month, you can see the last day closed down, so we were not able to buy the low, but we were able to sell the high. We took two losers, and we took a fairly nice big winner. Let's keep going. I zoomed in there. All right, there we go. So those two candles together are a Sunday candle. That's why I'm sort of treating them as one. So I just go back and I place the sell order there. So the reason why I'm not placing orders with every single candle is just to make sure that this video, is not too long. It's only about 6 minutes long. All right, again dealing with a Sunday candle, and there's a breakout. So we're going to attempt to buy the high. Buy the low. We've already sold the high. All right, here we go. Narrowly survived that, and price isn't doing much. Price blasts through our high, and there we go. So we managed to buy the low. We did not manage to sell the high. New month, here it goes. And there I am just looking for the low. And then we have a breakout. So those two candles there, those two are 1 day's candle. That would be the full Monday candle, hence why I don't treat them separately. All right, so far in this month, I was just about to say we'd sold the high and bought the low, but I guess what I wanted to point out here is you can see how much we've been chopped around, right? We've hardly caught a breakout. We really have been sort of battling with this. There's a breakout lower again. Again, those two candles would make the full Monday candle. So we've taken a loss in this month we're in now. We've bought the low. We have so far we sold the high. It doesn't look too good, and we're out. Need to be prepared to buy the low there. Right, there we go. So I'm just looking for the short breakout. It doesn't happen. And I think those two with the Monday candle, I did check, it still doesn't happen. And I think here again, Monday candle, and there we have our breakout. So nice, really nice big move there. But that's exactly how this kind of approach to trading would work, right? We're looking to participate. Now, this actually gets a bit messy. I made a mistake there. I should have put the stop loss above the swing high, but I didn't. I put it just above the candle. Now, when I do this kind of testing, I don't go back and fix that for the simple reason that mistakes when we trade are common. Okay, we all make them. So when I make a mistake in my testing, I leave it. All right, because the reality is that they're going to happen in real life too. So I think they get a better result. And then I just put this note in here to make sure that everyone understood the sort of mistake that I made. So in essence, what happened is I took 2 losers here, whereas I should have only taken 1. It doesn't really matter. And then I just had to fix the order quickly. Two losers in a row, and there the month closes. I think we are about a minute to go on this video, and then I will share the results. Okay, so new month, candles closing down, breaks out lower. We're going to assume that that is the high. All right, we suffered through a lot of chop, and then we caught a couple of really nice breakouts. And amazingly, this short position survived. Incredible. Keeps going. And that breaks out higher. You can see that, and immediately stops out, but we take it anyway. Okay, out we go. Another attempt at buying the low. I made sure this time that I put my stop loss low enough. I decided I wasn't going to get caught with that again. All right, high of the month gets absolutely blasted out, and we catch another nice big move. So, just having a look at what we went through, you can't say that we had a really easy start. We had a pretty rough start, and you'll find the market tends to move like this all the time. I just brought up the sort of stats here. There were only about 20 trades in this example. I actually ran through this test, and then I forgot to record it, so I had to go back and do it again. But you can see we had a sort of a nice kind of profit there. Now, I wouldn't use that necessarily as my risk. In fact, we'll go back into that in a second. So this is how that system did. So I did 100 trades. And what I did is I normalized the risk. So I had a couple of questions on that earlier. What I did is I normalized the risk. So all that means is that I changed it to, I think from the 0.1 lot size that I was taking, I assigned a risk of 1% or 1R as it were. So if you were to look at this and you wanted to assign it in a more useful way, think of it as a sort of a 1R trade. That lost. And you can see what happens is, if I move over to the next page, we tend to get chopped around quite a lot, right? And then price rockets off and we capture these big winners. And this is very common in a system that's designed to simply participate in the market. You'll sit through getting slapped around a bit, I guess, and then you have to sort of work out your profit from there. So why did this test work? And the reason is not because we were clever with our entries. We didn't use any analysis. It worked, and even though we got slapped around, but it worked because we gave our trades a chance to run into profit. Right? That was literally the only reason why it worked. And it was really dead simple, wasn't it? And all we had to do was participate in every profit-making opportunity. And I challenge you to try and replicate this yourself. Take out a pen and paper and have a look in your charts. Now, I did want to mention just 2 problems with this. If sort of anyone is interested in kind of copying it or having a look at the results, I didn't cherry pick this patch in the market. Okay, so you may look at those results, those 100 trades, and you think, well, he's gone and he's found an amazing part of the market to test. I genuinely didn't. However, I may have simply found a better patch. All right, so we may be curve fitting it here. You need a much longer test, and obviously the other downside was much longer periods of being chopped around. So that really is the end of what I wanted to cover tonight. So if you'd like the full test from this little system that I showed you, please let me know, and I'm more than happy to email it to you. There's only about 100 trades in it. If you'd like to chat about simplifying your trading, I'm also happy to chat with you. And if you'd like to tell me off because I made fun of Elliott Wave's fundamentals or technical trading, I'm also quite happy to have that conversation if anyone would like. But that really is what I wanted to cover tonight. I hope it has been useful in some ways. Okay, I hope it has challenged a couple of assumptions you may have in the market. Yeah, so that was really it, guys. I know it's quite a diverse topic. There's a lot of different things that we could discuss. But I tried to focus it on these sort of core areas. I think we could go into any of those, and we could look at a whole lot of other things. I mean, I've done other webinars where we've literally traded on the flip of a coin. Okay, and we've made profit. So yeah, so if you'd like to reach out to me, please drop me a mail. I won't have all these questions when the webinar stops, so I may have missed them. So do just drop me a mail, and I'm happy to share. So if we have another minute, I will try and answer sort of questions as we go. There's one here on the system that I showed. Where was the stop loss? So the stop loss was literally, I was trying to make it sort of below the swing low of wherever price turned around, but you could also put it just below or just in front of the signal candle. You'll find that your win rate is even worse, but you'll get a better return. It really won't make too much difference in the long run. So yeah, thanks for the question, Richard. All right, guys, I think we are pretty much up with time. So again, please drop me a mail if you'd like to chat about it. I hope I didn't offend anyone too much with some of the comments that I made. It really wasn't my intention at all, but great audience again. Thanks very much for your time, and have a good evening.